Dividends are back in popularity mode. First it was the growth stocks these last couple years, but now we're seeing a trend and a movement towards dividend growth stocks. It also was about bashing funds like SCHD for the last couple years. Now everyone is buying into SCHD and asking if they're too late, and I called it. I said in several videos over the last couple years that this would occur, and when dividend stocks or ETFs were out of style, I said now is the time to accumulate shares. I did myself, but there's more going on now than just that. And I recently looked at a Barron's article, so I want to talk about this. They said dividends are no longer just for utilities, real estate companies, and other more boring value-oriented sectors of the market. Google and Meta started paying dividends for the first time earlier this year. I think that was a big shock to many of us, and that helped lead to a big boost in the overall amount of dividends from U.S. companies, according to a report by Janus Henderson Investors. Now, dividend payments issued by American companies rose 8.6% in the second quarter to $161.5 billion, according to findings from the Janus Henderson Global Dividend Index. Now, Google and Meta accounted for nearly $4 billion of that figure. So globally, dividend payments were up 8.2% in the second quarter, hitting a record $606.1 billion. HSBC, Nestle, and China Mobile were the largest dividend payers. Microsoft was the biggest U.S. dividend payer and the seventh largest overall. It put out nearly $5.6 billion in dividend payments in the second quarter. Apple was the only other U.S. company among the 20 largest global dividend payers. It had a quarterly payment of more than $3.8 billion, ranking it 19th. Now, Janus Henderson said it now expects companies around the world to pay a record $1.74 trillion in dividends this year, which is up 6.4% from 2023 levels. It had expected a dividend increase of just 5% following its first quarter report. Now, the initiation of dividends from big U.S. media technology companies like Meta and Alphabet, along with China's Alibaba, among others, is a positive signal. Now, Alibaba issued its first dividend last November, so we have a lot of firsts these last couple of years, and that's really great for us investors, especially if we've been invested long-term in these companies. Paying dividends will also broaden their appeal to investors from whom dividends are a vital part of their investment strategy, and it may also encourage more companies to follow suit. With Meta and Google now paying dividends, that means 5 of the so-called Magnificent 7 are doing so. The only holdouts are Amazon, which I believe will pay dividends someday in the future. Their cash flow is huge. I just think this company will eventually get to that point. And Tesla's another one that's not paying dividends. Payouts from big tech firms are still relatively tiny. Nvidia, for example, has a dividend that yields a very small 0.04%. That is minimal. Microsoft, Apple, and Meta, and Google also yield less than 1%. But I will say I'm getting more than 1% from Microsoft, and we'll talk about that in a minute. Still, investors have been flocking to dividend-paying stocks as of late due to the Fed rate cut and those expectations that they may continue cutting going forward. And that means long-term Treasury bond yields have tumbled from a near 4.5% to about 3.7% since early July, which makes income-producing stocks all the more attractive. To that end, the S&P Dividend ETF SDY is up nearly 6.5% in the past 3 months, compared with a 1% increase from the S&P 500 index. Blue chip companies appear to have room to boost their dividends as well. Strategists at Bank of America Global Research noted in a report Friday the percentage of corporate earnings paid to shareholders as dividends, aka the payout ratio, is near a record low, unlike stretch levels from 2008, which means those low payout ratios means they have enough room to grow those dividends and increase that payout ratio to us investors. So this suggests safer dividends that could make up more of the total return. And with investors suddenly worrying more about an economic slowdown following all the data we've been getting, there could be a continued flight to safety in the market, aka those dividend-paying investments. Now, the Fed is cutting those interest rates to combat slowing economic growth, and if the economy were to fall into a recession, the defensive nature of dividend payers should prove beneficial, as those companies that pay dividends are ones that kind of have a long tail of history of being profitable. Therefore, they choose to pay out a dividend. And if they increase that dividend year over year, that's even better news for investors to choose those investments. So owning stocks that provide a stability of a steady dividend seems much more important given the market volatility of the past 2 months. And just right here, if we look at SCHD, one that I hold in my portfolio, over the last year, it's up 10.64%, but over the last couple months, it's really shot up. And this is what's happening with all these dividend stocks and ETFs. They are going up and they're catching this wave, and I think that wave will continue for a while. But let's look at some data from my portfolio. This is something that I'm going to share with you guys. Not a lot of people do, but I have all my investments with their dividend yield and their yield on cost, as well as the projected annual income each provides to me. So you'll see Microsoft, for example, if you were to buy today, their dividend yield is about 0.77%. Because I bought earlier at a much lower price point, my yield on cost for what I paid for it is higher at 1.39%. That's the power of long-term investing. And Microsoft is going to be paying me about $123 a year. Now, Amazon, Health Equity, they do not pay a dividend. Of course, we have SCHD, and right now they're poised to pay me $458 a year. The yield right now is 3.34%, but I'm getting 4.11%. Realty Income pays a now 5.09% yield. I'm getting a nice 5.75% yield on cost, and they're going to give me about $351 a year. Now, my energy ETF, it's a very small holding, but their yield is 3%. And because this one has risen up massively, my yield on cost is 5.46%, so I'm getting $16 a year from this little ETF that I hold. Warner Bros. Does not pay a dividend. Now, the large cap SCHG, the growth fund, does pay a small dividend of 0.41. This is a newer investment of mine, but it has been growing in its stock price, its appreciation, so I actually have a better yield on cost of 0.45%, and this investment is going to give me $27 a year. Union Pacific, my yield on cost is 2.73%, which is higher than the yield you get right now if you're to buy in at 2.20%. This one pays me $166 a year. S&P Global, the yield right now is 0.71%. I'm getting just over 1%, so that's great, and I get $92 a year from them. Vici Properties, the one I went really heavy in because I knew REITs were going to be hit hard with the high interest rates, and I wanted a quality company that I can really accumulate shares in, and that was Vici. Right now, their yield is 5.22%. My yield on cost, 5.89%, and they'll be giving me $942 a year. So I'm going to get about $2,176 a year. Overall, the dividend yield on my portfolio is 1.88%, but my yield on cost, what I'm getting is 2.44% on average. Now, this isn't a high yield compared to probably other portfolios, but I'm not a dividend-focused portfolio. I'm a mixture of growth and dividend growth. So therefore, my yield's going to be smaller just naturally, but very healthy when you compare each individual one to see just how much higher my yield on cost is than the dividend yield in the current market. And that's what you need to do. That shows the success of an investment. If it was switched where your yield on cost was lower than the yield that you could get now, that means that stock has gone down. It's fallen below your cost basis. You do not want that to happen because then people buying in currently will get a higher yield than you, even if you held this stock for 5 years, let's say. So with that said, let's dive into each stock briefly and talk about their dividend. Now, Microsoft, the one thing, if you look at all 4 charts, what chart is the most important when it comes to dividend safety, dividend health, and the company growing those dividends? Well, if you haven't guessed, it's free cash flows. So in the upper left-hand corner, you'll see Microsoft's free cash flows are ginormous, above $70 billion, and they're growing, which makes that dividend very safe, especially when long-term debt is also going down and net income's going up. That means expenses are being managed really well. And then, of course, that boosts revenue. But really, it's that free cash flows that the company can take to give profits back to investors, either through a dividend or share buybacks. But right now, we're focusing on dividends. So with Microsoft, you'll see here that their growth rate is excellent. You'll see the growth of Microsoft's dividend over the last year is 22% versus 5-year at 12.53%. So they're accelerating the growth, and their payout ratio is very low at 28.14. This is exactly what that article is telling you. Their low payout ratio means they have a lot of room to continue to grow this dividend. And that's why I love this holding of mine of Microsoft. It's going to be a dividend powerhouse, and it's going to keep growing my yield on cost versus the market yield. And I love that. Amazon does not pay a dividend, but I believe they will soon. And there's one reason why. Look at that free cash flow charts. It swung from the negative 20 billion now to just above 50 billion. I believe someday with this continuation trend of their free cash flows, they will need to get rid of that money somehow, and they'll give it back to us investors in the form of a dividend. So let's see how long it takes them. My guess is within the next 2 years, but regardless, I believe someday they will, and I'll be very happy when they do so. Next investment that does not pay a dividend is Health Equity, but they did something else. You'll see their free cash flows is growing. This is beautiful. Instead of paying a dividend, they did announce $300 million in share repurchases. So that's another way that they return profits to us investors. But someday as well, I believe they will pay dividends. But I think that is a little further out, as this is a smaller company. I think they still need to grow their free cash flows pretty significantly. So maybe within the next 5 to 10 years, they'll be paying a dividend, and that will be awesome. Realty income. Now, instead of free cash flows, with REITs, you look at adjusted funds from operations, and you'll see there it is growing. And then you want to look at their AFFO per common share, and that's also growing. That's showing that they can sustain their dividend, paying it out, and even raise it. Now, REITs must pay out at least 90% of their taxable profits to shareholders, and as a real estate company, they really depend on high-quality tenants who will pay their rent. Realty income has high-quality tenants. They have like a 98% occupancy rate, so that to me spells safety with their dividend. And you'll see they are a lower growth company with their dividend. Over the last year, it's 3.13%, and over the last 5 years, it's 3.07. Now, Warner Bros. Discovery, this is one I plan on selling. And with their free cash flows, you'll see it has gone up overall, but then it went back down. It's kind of been struggling. But look at that. You see Microsoft with $70 billion in free cash flows. This company is struggling to get $5 million. That's not a lot. This company will not pay out a dividend in the very long foreseeable future. I just wanted to mention this company just because it's one of the stocks I do own, but I do plan on selling this someday. On to Union Pacific. Now, their free cash flows have been going down actually, which really sometimes that's not a great sign, but sometimes it's okay, because with a company like Union Pacific, they have to invest a large amount of money into the infrastructure of the railroad system. So sometimes those expenses cut into that. But the thing that I like to keep in mind with Union Pacific is this company is not going anywhere. I believe that this company will be around for the next 100+ years easily. And any other company that tries to come in and open up shop as a railroad company, probably very unlikely, as it'd be very expensive to build out another railroad system. It's already dominated by a handful of companies, and Union Pacific is one. So I think that's the safety that I put into this company. But if we look further, the 1-year growth rate is only 3%, but the 5-year is 6.68. So they have been kind of slowing it down, but that payout ratio is at 50.33%. Now, that is not the best payout ratio, but it's not the worst payout ratio. Most companies around this level are okay. They're safe. When it starts to get above 75%, that's when you start to really keep an eye on it and worry if they will not grow their dividend or maybe even cut it. But at 50%, it is safe. Historically, it's been around this level. And so I just really think Union Pacific might not be my strongest dividend payer, but it is in the sense that this company is grounded. It's not going anywhere. There's no real competition that's going to wipe them out. Next up is S&P Global. Now, their free cash flows have been a little bit all over the place. They've kind of been stabilizing the last 3 quarters. So if we look here, we'll see their 1-year growth rate is 1.11%, where the 5-year was 9.81. So it has slowed down significantly. But what I like about this company is their payout ratio is very small at a 34.54%. So they have plenty of room to grow this. They've gone through some acquisitions, and I think they're just ironing things out before they start boosting that growth of that dividend again. Lastly is Vici, a beautiful company. I just love this company. I'm glad I took advantage of it while the rates were high and the fears were high with real estate companies. And Vici's adjusted funds from operations is growing, as well as their AFFO per common share. So what this shows us is that they've been able to grow their dividend higher than other REITs. So the 1-year growth rate is 4.22% and the 5-year growth rate is 8.51%. Now again, REITs have to pay out 90% or more of their profits to shareholders, so a payout ratio for a REIT of 67.4% is excellent. This company is in excellent financial condition. Their dividend is very safe. I really am happy with this investment. Now onto my portfolio. You'll see here I'm almost at 30% in the green, and with all my companies, you'll see Microsoft is up 81.89%. That's why my yield on cost is so much higher than the market yield. And then I'll just point out Vici. You can look at all the other stocks. Feel free to pause the video and take a look. But they are in the green, 13.24% for me. Not too long ago, they were in the red for quite a while, and they'd pop in the green and go back right into the red. But now they're strongly in the green, and I believe in a year, Vici will be over 20% in the green for me. They make up a large percent of my portfolio at 16.68%. I think I bought in heavily at the right time. Now I'm cooling off on this investment. I'm taking a break for a while, and I'm happy I did that. Hopefully you guys got to take advantage like I did with some of your dividend stocks. Let me know which ones you were able to. So with the expected influx of investors investing in dividend stocks for safety and income, is it too late to buy? No, I do not think so, but it's not the easy money it was before the Fed reduced rates and before investors' expectations were confident of a rate reduction, as dividend stocks have been rising over the last 2 to 3 months, as we have been seeing. But I feel there will be a decent run of investors moving towards these types of investments over the next year. For the past few years now, I really advocated and stressed on my channel that while rates were at historic highs, it was time to accumulate shares of those quality high-yielding stocks, as there would be a time the Fed would lower rates and these suppressed stocks would turn the tide and start to rise again, and that is exactly what is occurring. I say if it's a quality company with strong financial metrics that you will benefit regardless of when you buy in, but getting in now will still couch that wave that I expect to get larger over the next year. So let me know what quality dividend stocks you believe will be huge dividend growth winners, as well as appreciate in value, as it will be ones that investors will see as a safe income play, and you'll have a lot of them buying into it. That's all for today. Thanks for joining. Be sure to subscribe for much more content coming up. Have a great day.